Welcome back to Revise and Resubmit. Today we're going to dive deep into something that might flip how you think about money.
Oh.
Yeah, we're calling it the sugar daddy effect. And it's all about how having a constant flow of cash could actually, get this, make you less successful.
Interesting, yeah, because you always think more money, better results, right?
Right. But not so fast. We're going to look at this through three totally different lenses.
Okay.
Corporate venture capital, CVC, then those huge government funds, sovereign wealth funds, and finally green investing. I mean, they seem like totally separate worlds.
Yeah, totally. But there's this interesting thread that runs through all of them, the sugar daddy effect we're talking about.
Right.
It's this idea that having that guaranteed money coming in, sometimes it can make you, well, a little complacent, maybe not get the best results.
I see. Okay, let's break this down. First up, corporate venture capital. Now, for anyone out there who's not swimming in the VC world, imagine this. A huge established company, like a tech giant or a big pharma player, decides to invest in a tiny startup. That's CVC.
Got it.
And here's the thing. CVC has just blown up in recent years. It's almost half of all venture capital investment now.
Wow, that's huge.
It is. So the question is, why are these big companies already successful throwing so much money at startups?
Yeah, it's not like they need the cash, right?
Right. What's the motivation?
Well, I think one way to see it is think about how a company grows, the corporate life cycle.
Okay.
So a company in its early days, they're laser focused on their core business, right? Every dollar goes into R&D, marketing, just expanding like crazy.
Makes sense.
But as they mature, they often find themselves with, a lot of cash on hand.
Oh, I see.
And fewer places to invest it in their own business.
Right. They've kind of hit a ceiling with what they can do internally.
Exactly. So that's where CVC becomes attractive. It's like outsourcing their R&D in a way.
Tapping into the fresh energy of startups.
Right, exactly. Like look at pharmaceuticals. They're pouring billions into these biopharma ventures, hoping to be on the cutting edge of, the next miracle drug or therapy.
It's like they're hedging their bets, right?
Yeah, spreading the risk instead of betting everything on one big internal project.
That's a good way to put it.
And there's another angle, too. Sometimes CVC is strategic, to make their core business even stronger.
Oh, interesting.
Like, imagine a retail giant investing in a logistics startup to streamline their supply chain.
So it's not always about just making money. It's about improving their own operations, too.
Exactly.
Okay, but here's where it gets kind of tricky. Most CVCs, and this might surprise you, aren't actually independent.
Really?
Yeah, they're often tied to the parent company, which raises some questions about how much freedom they actually have.
I see. So it's not a pure venture capital play then.
Right, and ultimately it makes you wonder, how well do they perform, especially when you consider those mixed motives. Are they chasing profits or strategic goals? It gets a bit murky.
Yeah, for sure. And actually measuring how well a CVC does is really difficult. Not all CVCs are the same. In fact, research shows only a tiny percentage actually focus mainly on just financial returns.
So how do we even judge their success?
Well, one way is to look at data from these big CVC surveys. There was one by Silicon Valley Bank in 2024, major player in tech and venture capital. They found only about 15% of CVC funds are purely focused on profits.
Interesting. So most have a mix of financial and strategic aims.
Yeah, absolutely. And that same survey found something really interesting. Companies that get backed by CVCs, they actually tend to fail less and get more rounds of funding compared to companies backed by traditional VCs.
That sounds like a good thing, right? Less failure.
Well, on the surface, yes, but dig a little deeper.
Okay.
You see, traditional VCs, they're known for being ruthless. If a startup isn't working, they'll cut their losses and move on.
No mercy.
Right. But CVCs, they might hesitate, especially if the investment helps the parent company's strategic
I see where you're going with this.
Yeah, right. It's the sugar daddy effect kicking in again.
That steady cash flow means less pressure to perform.
Exactly. Less urgency to make tough choices.
So less efficient use of money compared to those hardcore VCs.
You got it. It's like when things are too easy, there's less need to innovate,
Yeah, that makes sense.
Oh, and here's a really interesting piece of evidence. A study back in 2010 found that when a company announces a CVC investment, their stock price often goes down.
Really? So even the market, which is usually all about growth, is skeptical of CVCs.
It seems that way. Like investors are saying, we're not convinced this is a guaranteed win.
Wow, that's telling.
Yeah.
Makes you wonder those strategic benefits are worth the potential downsides.
Yeah, it's a good question to ask.
All right, so we've tackled CVCs. Now let's switch gears completely. Let's talk about sovereign wealth funds.
All right, the big leagues.
The big leagues, yeah. These are funds created and funded by governments, and we're talking trillions of dollars here.
It's almost unimaginable, right?
It is. And over 60% of these funds come from countries loaded with natural resources, especially oil.
Right.
It all started back in 1953 with Kuwait. They decided to create a fund to invest their oil wealth for, the future of their people.
Smart move, realizing that oil isn't forever.
Right, so it's like a giant national savings account to ensure their prosperity down the line.
Exactly. But what sets sovereign wealth funds apart is that they have a lot more control over how they invest.
Oh, interesting.
They're involved in everything from deciding what types of assets to buy, to picking specific stocks, to even evaluating how well their investments are doing.
I see. They're not just handing the money over to someone else.
Right. And this is where it gets really fascinating. Over time, these funds have been given tasks beyond just making money.
Oh, like what?
Well, take Saudi Arabia's Public Investment Fund. It's a key part of their Vision 2030 plan.
Okay.
They're trying to diversify their economy away from oil, investing in things like tech and tourism.
That makes sense.
Then you have Norway's sovereign wealth fund called Norges. They're big into green energy infrastructure.
Oh, cool.
Aligning their money with their national commitment to sustainability.
So it's like they're using these huge sums of money to achieve national goals.
Absolutely, whether it's economic change, environmental goals, you name it.
So the question is, how do you measure their success?
Yeah, is it just about profit or are there other factors? It's tricky.
It is tricky, and the answer isn't always pretty. Research shows that, on average, sovereign wealth funds actually do worse than the market.
Really? You'd think with all that money and expertise, they'd at least match the market.
Exactly. So what's going on? Are they just bad at picking investments?
Well, one thing that seems to matter a lot is transparency.
Okay.
The most successful funds, like Norway's Norges, they're very open about how they operate, what they own, and how well they're doing.
Like they put it all out there.
Yeah, detailed reports, engagement with stakeholders, the whole 9 yards.
It's like they say, sunlight is the best disinfectant.
Exactly, but the funds that have had scandals and bad performance, they were often shrouded in secrecy.
Makes sense. Harder to hide problems when everything's out in the open.
Right. It highlights the danger of too much power and not enough accountability, especially with public money.
That's a good point. Okay, so we've looked at corporate venture capital and these massive sovereign wealth funds. Both have this mix of financial and strategic goals. Now let's dive into green investing. Putting money into fighting climate change, building a sustainable future.
Okay.
And a lot of people think the biggest hurdle for green energy is lack of money. But guess what? That's just not true. Trillions have flowed into green investments.
It's mind-blowing, right? We're not talking small change. We're talking massive institutional investors, pension funds, even regular people who want to put their money where their values are.
So if money isn't the issue, why haven't we seen more progress? Why are we still so hooked on fossil fuels?
That is the million-dollar question. And it gets to the heart of why green investing is so complex.
Yeah, break that down for us.
Well, one challenge is that green investors, they can have really different motives, sometimes even conflicting ones.
What do you mean by conflicting?
Okay, some investors, like certain foundations and endowments, their main focus is impact.
They want to make a difference.
Exactly. And they're willing to take lower returns if it means supporting environmental goals.
That's noble, but not everyone can afford to do that, right?
Then you have impact investors. They want both market-beating returns and to make a positive impact.
So they want it all.
In a way, yeah. And that creates a tough situation because expecting stellar financial performance and solving big environmental problems, that's a tall order.
It's like trying to walk a tightrope.
Exactly. And when you look at the data, it's a bit sobering. Despite all the money poured in, green investing hasn't had that big of an impact.
Really?
Yeah, get this. The total value of all publicly traded alternative energy companies combined is actually less than ExxonMobil alone.
Seriously. All that solar, wind, electric cars, everything, it's still smaller than one oil giant.
It is. And even with trillions invested, fossil fuels are still over 80% of global energy use. That share has only gone down 5% in 20 years.
Wow, that's pretty disappointing.
It is. Makes you wonder if all this well-intentioned money is actually having the effect people hoped for, or if it's distorting the market.
Right. Were we picking winners and losers based on what's popular rather than what's truly effective?
That's a valid concern. And there's another layer to this. Nuclear energy, which has actually been one of the best ways to cut carbon emissions, often gets left out of green investing.
Because of the stigma, I guess.
Yeah. But imagine if even some of the money that went into solar and wind had gone to safer, more advanced nuclear tech. Things might look very different today.
It makes you wonder if all this focus on certain green technologies has actually slowed down the development of other solutions that might be better.
It's definitely something to think about. Are we truly seeing the best innovation in energy, or are we just seeing what's getting funded because it's politically popular?
Okay, so we've explored these three areas: corporate venture capital, sovereign wealth funds, and green investing. They seem so different, but you're saying they all share this sugar daddy effect.
Yes, they all have that element of assured funding, which can have some unexpected consequences.
Because there's less pressure to deliver.
Exactly, and this can show up in a few ways. First, there's less urgency to build a really solid business model or make the most efficient investments.
Because the money's just there.
Right. Second, there's less accountability.
Oh, interesting.
If an investment does poorly, you can always blame it on the long-term goals or the side missions.
Like a built-in excuse.
Exactly. And third, it lets weaker companies survive much longer than they would in a truly competitive market.
Right. They're being kept alive artificially.
Exactly. Remember how those CVC-backed companies had lower failure rates? Well, in a normal market, those underperformers would have been weeded out.
So it's like they're on life support.
A good way to put it. And that highlights something really important. Failure is actually crucial for a healthy system.
In what way?
Well, when things fail, it frees up resources to go to better ventures, it forces people to innovate, it prevents stagnation.
It's like clearing out the deadwood to make room for new growth.
Precisely. So this sugar daddy effect, while not always bad, can create an environment where mediocrity is accepted and real excellence is harder to achieve.
Because there's less incentive to strive for it.
Right. It's not about hating on assured funding. It's about being aware of the potential downsides and putting things in place to reduce those risks.
That makes sense. So what can we learn from the entities that have managed to thrive even with a steady flow of cash? What are they doing differently?
One key thing is independence. Take Norway's sovereign wealth fund, Norges.
Okay.
They operate pretty independently from the government, which lets them act more like a regular investment fund focused on strong returns.
So it's about making sure that people managing the money are accountable for how it performs.
Exactly. And that ties into another key factor, transparency.
Right, we talked about that before.
Yeah, Norges is incredibly open about everything they do, which makes it much harder to hide inefficiencies or make shady decisions.
It keeps them honest.
Exactly. And another lesson is to separate your motives. If you have multiple goals, keep them distinct and have clear ways to measure success for each one.
So don't try to do everything at once. Break it down and focus.
Right. And finally, you have to be willing to embrace failure.
Wait, isn't that counterintuitive? Don't we want to avoid failure?
I know, but think about it. One weakness we saw in all three investment areas was that reluctance to shut down things that weren't working.
Because there's always more money coming in.
Exactly. But if you want better overall results, you got to accept that failure is part of the process. Shutting down underperformers frees up resources for more promising things.
It's like pruning a plant to help it grow stronger.
Precisely. So cutting off those failing ventures forces adaptation, innovation, and in the end, leads to greater success.
That makes sense.
Yeah.
But what does all this mean for our listeners? I mean, most of us aren't managing billions of dollars.
Oh, absolutely. But even if you're not dealing with these specific types of investments, the lessons apply to any situation involving funding, whether it's a business, a personal project, even just managing your own money.
Okay, I like that. So give us some practical advice.
Sure. First, even if you have long-term funding, build in contingencies. Have clear conditions for reducing or stopping funding if goals aren't met.
So have a safety net, but also a plan for course correction.
Exactly. Second, every entity, whether it's a company, a project, even a personal goal, needs a clear core mission.
Stay focused.
Right. It helps you make better decisions. Third, if you're doing something with a social purpose, which is more and more common these days, be realistic about the trade-offs.
You're saying doing good often has an economic cost.
Often, but not always. The point is to acknowledge those potential costs up front and be transparent about them.
So don't pretend you can have maximum social impact and maximum profits with no sacrifice.
Exactly. And finally, see failure as a learning opportunity. It's okay to make mistakes, to try something that doesn't work. Actually, it's often essential for long-term success.
We need to get more comfortable with the idea of failing.
Yeah, failing is just data. It's feedback that helps you adjust and reach your goals.
So to wrap up this part of our deep dive into the sugar daddy effect, it seems like the main takeaway is this. Assured funding can be good, but it can also create an environment where performance suffers and weak things are allowed to survive.
It's a complex issue, no doubt. There are cases where assured funding has led to amazing innovations and positive change. But we have to be aware of the potential downsides and take steps to reduce those risks.
Absolutely. Independence, transparency, clear missions, and accepting failure, those seem to be the keys for entities that thrive, even with that steady flow of cash.
Well said. And you know what? This sugar daddy effect, it doesn't just apply to finance.
Oh.
Think about it. Are there areas in your own life where having that safety net that guaranteed something might actually be holding you back?
That's an interesting thought. Are we reaching our full potential, or are we getting too comfortable?
It's a good question to ask ourselves. And a big thank you to Professor Aswath Damodaran for helping us understand all of this.
Yes, the legendary finance professor at NYU. His work has been crucial for this deep dive.
Absolutely. His blog is a goldmine of knowledge. Highly recommend it to anyone who wants to really understand finance.
And for those of you who want to stay informed without getting overwhelmed, Revise and Resubmit is the show for you. Make sure to subscribe on Spotify, Amazon Prime Music, and Apple Podcasts for more deep dives like this one.
Thanks for joining us on this exploration.
And happy Diwali and happy Halloween.